because I actually spoke to Terry Ryder about this on the podcast.
Tezza.
Yeah, Tezza. And the theory goes that affordability is going to become worse for homeowners because interest rates are higher and they're not claiming any rent on their properties. So therefore, it's all coming straight out of the back pocket. Terry made a really good point that when people buy a home, they're not assessed on their actual borrowing capacity. They're assessed on their borrowing capacity plus a buffer, right, of, you know, two or three percentage points. So even if interest rates go up, it doesn't mean that people are going to suddenly, oh my God, I can't afford this house, and they're going to sell it, right? You know, that's likely not going to happen because the banks have already assessed their affordability based on their ability to repay at a higher interest rate. Does that make sense? Right? So, and I think that's a really smart point, right? Because what's likely not going to happen is people aren't going to suddenly have to start fire sailing properties and be like, oh my God, I can't afford this now. Interest rates have gone up. Because wages are going up, and also they're assessed on their ability to repay at a higher rate anyway, right? So people are still going to be able to afford it. But that being said, you know, it can affect home ownership affordability for your ability to get a loan, right? So if you're trying to get a loan and interest rates have gone up by, you know, let's say they've gone up by 2%, which they're not going to go up by that much anyway. They're only going to go up by like 2 basis points or something, and they're not going to go up by 2%, right? I don't think. So even if it went up by 2%, right, then you would be assessed on that increased interest rate plus the buffer, right? So it could actually be a barrier for people to get into the market, right? Which would be a decrease in home ownership affordability. But that being said, that doesn't mean that property prices are going to go down. And in fact, the borders have just reopened. You know, there is a lot of firepower behind the market. I'm going to circle back to the interest rates piece specifically. Some very interesting stuff that are coming out of the back of that. But you know, borders have just reopened. We've got international students arriving. We're looking at having I think a couple of 100,000 migrants coming in over the next couple of years. Like, it's huge, the amount of migration that's going on. That's all driven by a need for jobs. We've got record low unemployment rates. We've got a household and business savings war chest of $430 billion, which is being deployed at the economy. It's in cash. That's cash sitting in people's bank accounts,
wow,
which is hectic, which is the biggest it's ever been. We've got the highest household savings rate in 25 years. We've got the second highest disposable income percentage ever, even despite inflation. There's over $600 billion being spent by the government. There's a nationwide infrastructure boom. There's still relatively easy access to credit. Like, you know, it's like the access to credit's actually quite easy. You know, there's still a lot of lenders out there. There's like no one's talking about credit tightening at the moment. And also there's inflation, right, which is actually a good thing for property markets, right? So you've got all these underlying things that are, broadly speaking, driving the property market. We have got a crazy housing shortage. Like, it's insane. And we can't catch up. And so we already were in a housing deficit, I think, of about 144,000 houses. We were in that deficit already pre-COVID. And then because of all the supply chain disruption, we're now unable to get all the materials we need to be able to build houses, which is why building costs have gone up so much, which makes it unaffordable to build because building costs have gone up so much and there's huge delays. I know someone who had planned to build a duplex in, I think in Orange or something like that, or in Goulburn or something like that. But it's literally taking years because of COVID and now supply chain disruptions and all of that kind of stuff. And they're still potentially, I think, a year or 2 years away from even building it, right? Which is crazy. And so you've kind of got all of these macroeconomic factors which are driving a tightening in the ability for us to generate the housing that's required. So there's governmental issues and stuff. They need to be able to release more land. They need to be able to do all this kind of stuff. But the fact of the matter is we just can't build enough houses for all the people who want them, which is actually pretty wild, right? When you really think about what that actually means, that means that not everyone who wants a house can have one. To live in, to rent even, right? Yeah. This isn't just home ownership. This is dwellings per person or people per dwelling. So that also then extends into a rental crisis as well. Now, I'm not here to try and propose that anyone should be kind of like preying on the you know, situations of others or anything like that. But like, the fact of the matter is that as interest rates go up, rents go up as well. And as inflation goes up, rents go up as well. And right now, rents are going up.